Personal. Okay. Hello. Oh, okay. We have some people coming in. Okay, great. So I know some of you may have seen Maggie present with us before. Maggie is just a well-known national expert and certified financial planner who has incredible insight around the many ways that we can be more mindful and I guess take better action around the ways that we are handling our money to create a better financial future for ourselves and to really plan for longevity and what life brings. So I think you are really going to appreciate what she has to share. Maggie, by the way, has an incredible YouTube channel. She has an incredible Instagram account. If you are into social media, connect with her. Tons of information there. And I just want to share that Maggie, with her company, Money with Maggie, is an official partner with the Institute. So we're really grateful to be partnering with Maggie and with all of the wonderful strengths and gifts and knowledge that she brings. So Maggie, I'm going to go ahead and turn it over to you.
Awesome. Thank you so much, Gina. I'm so excited to be here. So happy to be sharing the good word of increasing our wealth and doing the best that we can with our finances, especially when you can't really talk about money and finances in a lot of places. It's kind of taboo. And so any chance I have the opportunity to openly speak about money, it's just a great day. So I'm really glad to be here with you all. And I hope that we can all start talking about more money more openly, because it's what is underneath, like why we're working, what we're trying to do with our lives. Like money is a core part of our every single person's life. So it really shouldn't be so taboo. It could be a little bit more chill, but for now, it is what it is. I try to make money chats an open, welcome space. Okay, let me share my screen with you. I've got some things to go over. We're going to talk about how to plan to become a millionaire. And some of you may have this on your planning. Let me move my screen really quick. I'm like confused. Okay. Some of you may have this already dialed in. Some may feel like this is never going to happen. It just varies from person to person. And I want to show you how you can actually take a little bit of control in the situation if it is something that you want to get towards. And if you fall short, there's nothing wrong with that either, because you're still in a better position, most likely, financially anyways. So today, I'm just going to give you a little introduction about myself. We're going to get into cultivating a desire for wealth. We're going to look at what does $1 million+ mean to you. And I'm going to show you some tactical things of running your numbers, both using investing, which is what I teach people how to do, and if you weren't to use investing. And so you can see the difference of how much longer it would take you to reach those goals if you're not utilizing these tools that are available to us. Because often I see that, and this is part of why I left corporate America, but people feel like they don't have enough to invest, or they're too behind to invest, or they just don't know what they're doing. So they leave this tool on the table, and it is what the wealthy use. It's a part of what the wealthy use to grow their wealth. So it shouldn't only be accessible to the wealthy. It's accessible to everyone. We just have to kind of do a little bit more work because we might be on our own figuring it out. So that's what I'm here to help you do. And then we're going to get into some questions. So feel free to drop those through the chat, like Gina said, as we go. And I will answer those. I might answer them at the end, but if it's something that is relevant for the current thing I'm sharing, just feel free to raise your hand or pop in or whatever. Okay. So a little bit more about me, like my background. So I've worked for the big brokerage firms, Charles Schwab, Morgan Stanley, E-Trade, as a financial advisor, and I am a certified financial planner. Whew. I'm also 34 weeks pregnant, and so I run out of breath pretty easily. So give me a second sometimes, but still excited to be talking about this stuff. Okay, so while I was at these big firms, I realized that it was only the wealthy that had access to work with people like me and my colleagues. You had to have hundreds of thousands of dollars to get an appointment with us. Otherwise, you're sent to the call center. And I just really just felt like I need to help people that don't have that huge amount of money, because I was never in that position growing up. I'm barely like getting into, I'm in that, I would say, in that position now. But 7 years ago, I was living paycheck to paycheck with a negative $50,000 net worth. And I started practicing these principles, mainly not only from what I learned in studying to become an advisor and work with these people, but also in practicing what I learned from my clients, my wealthy clients, right? I started asking them questions, what, how, and observing their portfolios and like really paying attention, and then putting those to practice in my own life. And now we've been able to grow our net worth to over $700,000. And I help others gain control of their financial lives and start investing to grow their wealth, regardless of their starting point. And just on a personal note, my mom moved here from India when she was in her 20s, and she just instilled this deep sense of gratitude for the opportunities that we have in America. But she also had this chip on her shoulder, I guess I would say, that like there's certain things for rich people and certain things for like the rest of us. And it always intrigued me to wonder, like, what is it that, like, I want to be this, like, I want to have what these rich people have. Because we would see something nice and she said, oh, that's for rich people. And so that kind of just put it in my mind, like, well, I want to be a rich person. And so that kind of put me down the path of studying money and finance and all that stuff. And also just to take care of her. She's just had a really, really rough life. She married an alcoholic. He passed away when I was 16, and it was a nightmare. And she's just like worked so hard and really not gotten very far financially. So I just feel the deep desire to take care of her. And that is my big, big why I'm so motivated by money. It's not just for the sake of having money, but the opportunities that it can give both me and especially my mother to escape the poverty rat race, all that stuff. My next big goal is to buy her a home, and I just like cannot wait to do that. Not too far down the road, but anyways. Okay, so let's get into this a bit. And speaking of that, like that desire I have for building wealth for me is based on my mom. A lot of it has been. And so let's talk about cultivating a burning desire for wealth. I've incorporated some of Napoleon Hill's teachings from Think and Grow Rich. Let me know in the chat if you guys have read this book or heard about this book. It's a classic. It's been around forever, but like it's one of the books that like helped me kind of think through this, what's it called? The mindset side of the building wealth part. You know, it's like two parts. There's the mindset part, and then there's the tactical part. So today we're going to bring them together. But he says, only those who become money conscious ever accumulate riches. Money consciousness means the mind has become so thoroughly saturated with the desire for money that one can only see oneself already in possession of it. So this is where you just start to think you already are in possession of it and know that it's possible. So in his book, he has 6 steps to turning our desire for wealth into reality from this book. So he says, first, decide the exact amount of money you desire. Secondly, determine what exactly you intend to give in return for that desire. Third, establish a date when you plan to possess the money. And fourth, create a definite plan for carrying out your desire and begin immediately. That's specifically what we're going to talk about today, the plan, because I'm a big planner and I'm going to help you with this part. And fifth, write out a statement of the first 4 steps, and you read it every day, twice a day. So that's what's going to keep you motivated to sticking to the plan. So what does $1 million or more mean to you? List out all of the ways your life will change. Think both physical things like the comforts around your house and experiences, as well as the emotions that you'll feel. How will you feel and what will you have and do? Think through this so you can really start to think, okay, if I get good with my finances and really maximize what I'm able to do, what does that mean for me and my family? So investing is one tool that can accelerate the time it takes to reach your goals. This is something that I saw firsthand. And as a business owner myself, I've seen that investing, well, for me, investing is my backup plan in a sense to accumulate wealth. It's not my main plan. So a lot of us are working, right? That's primarily where we get the bulk of our money. And investing can be this thing that is, it could be your primary plan to generating a lot of money. It could also be your backup plan. So for many people, I would say for most people, it is their main plan to establishing wealth, meaning taking a small portion of what you're making and building that over time. But either way, whether it's your main plan or your backup plan, investing can speed up the time it takes to hit your first and certainly your next $1 million and more. It's easier than starting a business for sure. Knowing that that's how it, like being a business owner now for 4 years, I can tell you it is incredibly hard. And if any of you have businesses, you know, it is not an easy path to wealth at all. It's very, very challenging. But also investing, I can tell you it is so easy once you get past the initial hurdles of like what to invest in, what accounts, like how does it all work, all that like stuff. Once you get past that and you get on a schedule of being able to do it consistently, then it becomes the literal most easy way to ever possibly build wealth. I'm going to take a quick moment to look at the chat and just see. Okay, Megan says she has read the book. Gina, is she still here? I don't know, but hopefully she's okay. Okay.
I'm here. Do you
Oh, okay. No, I don't know. I just didn't see you. So that's okay.
I am here. I promise.
Okay, cool. Okay, so the question is, says, when you invest in the stock market, is that separate from putting money in one's 401k? So your 401k is one way you're investing in the stock market. And you can also invest in a regular brokerage account for money to grow for you before retirement. So I like to use both because your 401k does have limits. You are maxed out at about $19,500 per year, which is a high limit. Not everyone can reach that limit. But the thing with the 401k and IRAs is that money you can't access till you're over age 60 about. And if you do, then you will likely have some penalties, or until you like leave your employer. If you pull money out, you typically have penalties. So I like to also incorporate investing in a regular brokerage account, which we'll talk about today, for goals between now and then. So some of you might already be close to 60 and it might be less relevant for you to invest for like pre-retirement goals, but some of you may have 10 years, 20 years, and don't want to tie up all your money for retirement investing. So that's where you use the two together. And that's exactly what my husband and I do now. We've got our retirement accounts. That's just like, that's our long-term money. We put aside a percentage of our paycheck or pay there. And then we also have a brokerage account. That's where we pull out money for our down payment for our home. And if we want to do big projects that just cost more than we're bringing in on a monthly basis, we'll just pull from our accounts at this point now that they're well established. Okay, so go ahead and keep dropping any questions in the chat. I'm going to get back to this. So let's see, if you were to run the numbers of getting to $1 million, both using investing and not using investing. So here I'm going to share another screen with you, and let me drop this calculator in the chat. So if you're using investing, this calculator shows you how long it'll take to reach your goals. Let me get this calculator pulled up. I'm going to stop and then reshare a different screen. Okay, stop share. And now I'm going to go ahead and reshare another screen for you. But I would like to give you the calculator so you can either run the numbers with me or just save it and you could do it after the presentation, but I'm going to drop it in the chat for you. So this is just an investment growth calculator. I'm going to show you how to use it right now. Make sure and share the right screen. Got a few of them going here. Okay, share screen. All right, this is a really simple calculator. Sometimes it gets a little glitchy, so just make sure that when you're entering numbers, it's the numbers you actually intend to enter, because sometimes it just doesn't, just don't stick for some reason. Let me try to get the view a little bit bigger. Okay. Okay, so let's see. This just takes some trial and error, and I really can't remember the magic numbers to enter off the top of my head here. So let's say you start with $1,000. If you're entering your own numbers, literally enter what you have. You can enter 401k money, other money that you want to invest, whatever. Let's say we're just gonna look at what is it if you were to invest. I'm gonna start with 400 because I can't remember, like I said, 400 monthly. And I like to use 10% as a rate of return investing in the stock market, because historically speaking, the stock market has returned 10% on average for the past 100 years. So I still feel like it's a good number to use going forward because population is increasing. People are still buying products and services, even though the market is currently down right now. There's always a time in history where the market's going through tough times, I'll say. But that being said, it still has returned that average. Some years way more, some years way less. If you want to be more conservative, you could use a lower rate. I wouldn't use a higher rate just because, like, why would it? You can't count on it being higher than it's ever been. But historically speaking, that's what I feel comfortable with. So then you say, okay, well, if I did $400 a month, and actually, if you do this bi-weekly, it's better to do bi-weekly every 2 weeks, meaning, and then that would be 200, right? I was like, why did it jump to 400? So first, if you were to do $200 every 2 weeks for 20 years, that would take you to $300,000. So scroll down. What I want you to look at from this chart first, before we get to the million, right, is the idea of timing when it comes to investing. In the beginning, when you first start investing, the majority of your account's growth, meaning how big it gets, comes from your own deposit, you putting money inside the account. So that's the green in this chart. You can see in the early years on the left, the green is much bigger. It's a much bigger chunk than the yellow. So what that means is you've got to get good at just putting money in. And it's not until later that yellow, which is the compounding growth, really kicks in. And this isn't to discourage you from investing or make you think it's going to take a long time, but that's how it works. If you have more to start out with in the beginning, then it's going to be faster that yellow accumulates even faster. But if you don't, it might just take some consistency to get some money stacked up for you before that compounding growth really has a chance to do its magic. But if you look over a 20-year period, you can see the green. If you look at that pie chart on the right, the green is $100,000, meaning that's how much over 20 years, that's how much you've put in. So we don't even need to look at the other calculator really, because this shows us if we only save, we'll have $100,000 versus if you invest that money, then that investment grows to $233,000, bringing your total to over $300,000. So more than 2/3 of that is from investing growth. So that's why it's such a great opportunity and something you don't want to sit on, because it takes time. And it's fine if you start slower or lower, if you can't do $200 every 2 weeks. Like, that's really not the important part in the beginning. The beginning is the most important part, is getting consistent. Even if it's $50 every 2 weeks, any dollar amount, or even less than that. If you feel like you're just spending every dollar that you make, it's going to be a little process to kind of undo that habit, but you've got to give yourself a reason to undo the habit. So that's where saying like, okay, I'm going to commit to $20 a paycheck and put it in. And then the intention is there. And then you know that you want to get that higher, so that, going back to our goals, we can really fulfill those and see those through in this one life that we have to live. But now let's look, if we were to take this 20 years. So it takes 20 years in these numbers situation to get to 300,000. If you tack on an additional 10 years, so run that to 30, that crosses the $1 million mark. So it takes 20 years to get to 300,000, but just an additional 10 years gets you up over that $1 million mark. So some of us, we're not in our 20s here, right? I'm 38. We might not be like feeling great about this idea of 30-year planning, depending on your current age, but you do have to think that the numbers matter in a sense, but not, it's more the habit. Like, really think about that. And using compounding, even if you don't have this long time frame to invest for, you've got some time, you've got more time. People are living longer than ever, and you've got more opportunity than you might feel like you do to get started with this. But you can also use this as motivation to save more. So this growth has happened for my husband and I in 6 years, where we're not at $1 million yet, but we're well on our way. I think we'll be there in probably about 4 if we just keep doing what we're doing. But the reason that we were able to do it so much faster is because first of all, I really wanted to quit my job. So I saved for 2 years solid while keeping my expenses really low. I saved about 40% of my income. I got my income up, I got my expenses down, and I saved and invested everything I possibly could in a period of time, like the last 5-10 years, maybe 5 for sure. The stock market has returned almost 70%. That's more than 10% per year in the last 5 years. So I think the last 5 years has averaged about 13%. And I'm not sure if that's the last 10 years. We've had a huge, significant run in the stock market. And so it doesn't mean it'll continue, right? We don't know, but it can happen faster is the point, depending on how much you're able to save. That's why it's so important that you enter your own information here, because it's going to vary so much from person to person. And not only that, but don't let it discourage you if it's taking longer on paper. When I first ran these numbers, it was impossible. It was like, oh, great, this is never going to happen for me. But the more I looked and got motivation from my clients, the more I was like, man, there is something to this investing thing that can really, really help me change, that can just make this more of a reality for me. And that's exactly what happened, because I put into place investing. Like, that was just it. I was very confused even after I got all my Series 7, 66, my CFP. Well, by the time I got my CFP, I kind of knew what I was doing, but definitely. But before that, when I first started investing, I was so confused. I didn't know what the heck I was doing, but I knew investing was the way for me. So in this chart, also, if you scroll down, you can see okay, annually I'm contributing the same amount. That's the other thing. Over time, you're going to be able to do more if you're committed to this. And so this keeps it static if I wish it was like where you could increase it, but this one doesn't. There's others that do, but anyways, what I love about this is what you see. This column, interest earned, is, so in the first year you put in 5,000, you earn $300. In a few years later, you put in 5,000, you get 3,000. And then you see the shift where it's like, okay, you put in 5,000, you're getting 8,000, 9,000, 11,000, 15,000. In the later years, you're getting like $35,000 when you're only putting in $5,000. That's the power that I want you to tap into and really believe that that is possible. So that's what motivates me to invest and to teach other people to do it as well, because it can really, really completely change your finances. Let me go back and share. Let me know if you have any questions on that calculator. But let's see. And you saw that if you don't invest, it's just going to take you way longer. It's like, it almost becomes practically impossible unless you're like really able to save. And not to mention, inflation is just eroding the purchasing power of our cash. So our money is literally losing value when it's not invested because prices are increasing. So you not only want to keep up with inflation, but you do want to significantly outpace inflation so you're not losing purchasing power over time. Yeah.
I'm sorry. We do have one question here.
Sure.
Actually, two questions.
Okay.
The first question is, how do you know what to invest in? So where to place your money and how to choose those particular investments? And then the other question is, right now, there's been such a financial crisis. I would imagine this would be like a really good time to invest. What are your thoughts on that?
Yeah. Okay. So I like to, and this is a good spot to put this because it's really that's the question, right? It's like, how do we split up our money? There's thousands of options of what to invest in. So what I like to do is use an 80-20 approach where 80% is in index funds and 20% is in individual stocks for concentrated growth. The 80% is more for diversification and more of that like steady Eddie approach. And then the 20% is for concentrated growth. Now, if depending on how nervous you are and how much you don't like seeing your money go up and down, the 20% stocks might not be for you. Maybe you do 100% in index funds. And I'm going to show you a couple of charts so you know what I'm talking about. But in the index funds, so index funds are baskets of stocks, and that's why, so there's hundreds. If you own some index funds, you're going to own hundreds to thousands of stocks in just a few investments. And with stocks, you can have more money in fewer things, which allows for more of that concentrated growth potential, but also more loss potential. So let's look at a couple of charts to help us understand this a little bit. Let me get one pulled up for you. And then while we're there, we'll look at talk about the current moment in time that we're in with investing in the stock market. Okay, so we just start with classic Google. So we're gonna go S&P 500. This is a basket of 500 of America's largest companies, all in one investment. A lot of you will own mutual funds in your 401k. So what I want you to do at some time after this presentation is look at the options in your 401k and see if you have access to index funds or ETFs, exchange traded funds, because often you might be in high fee funds unknowingly. And not only that, because it's not all about fees, but you want to look at your fees compared to your performance. If you're paying more and getting worse performance, like that's not the point, right? You want to optimize your portfolio. So you're paying less and getting better performance. So that's the importance of running these numbers. And I'm going to show you exactly how to do this because I've looked at so many people's 401ks and done this exact thing that I'll show you. And I'm telling you, you could save thousands of dollars by just getting into something that is performing better and paying less on your fee. So first you start out by entering, well, we're going to look at the S&P 500. You can't compare everything to the S&P 500 because the S&P 500 is 500 stocks. It's an aggressive fund, meaning it's all stocks. Some funds that you have, like if you're in a target date fund, for example, that's going to have a mixture of bonds and stocks. So if you compare it to an all stock fund, you will never have the high performance that, like, your target date fund is always going to be less, but you want to make sure it's not like so bad. So anyways, let's look at this so you can kind of understand this a little bit more. So you start out, this changes the time frame. This is 1 day, 5 days, 1 month, 6 months. So we can see year to date, we've been down. We're down 13% year to date in what we would say is the stock market. The Dow Jones is also another benchmark that has 30 stocks. I like to use the S&P 500 just because it's more stocks. It's 500. The NASDAQ, so those are the three that you'll hear. The NASDAQ is technology stocks. There's like over 3,000 stocks in there. This has 500, and the NASDAQ is more tech-based, technology stocks. The S&P 500 has more of a mix of different types of stocks, and the Dow only has 30. So anyways, here, 1 year to date, so from January till now, we're down 13%. At one point, we were down about 20% in this, maybe a little bit more. And that's when we were talking about, when you hear everything about the recession and the bear market. A bear market, it means that you've had negative 20% returns in the stock market for a certain period of time, or maybe that's, I can't remember the exact criteria, but we definitely fell into that territory. But we've recovered some of that. Like at one point we had recovered 10%. It looks like it's gone down a little bit, but you can stretch this out. So over the past 5 years, we're still up significantly, 70%. So if you invested $10,000 5 years ago, and I just did an Instagram reel on this, so that's why I know this exact number, but you would have $10,000 or $1,700 basically, right? 70% more. $17,000 if you invested $10,000, that's $7,000 of gains in 5 years. So that's the why, right? Like, why would we invest? And if you stretch this out even further, it goes back to the 80s, and you can see our stock market has just done incredibly well, but not always. There was this 10-year period of time from 2000 to 2007, where it was just, if you had put your money in and didn't do anything else, it would have taken about 10 years to recover that money. But the thing with investing is you don't just put your money in and do nothing else. You have to keep investing over time, because what happens is, even if the market's going down, so we're way over here, okay? In this chart, let me see if I can increase it. We're way over here. Now you can see this sharp decline, right? If you had been investing in what people want to do when the market drops is they want to stop investing. They get freaked out. They don't want to lose money. That is the exact opposite thing that you could do for your long-term success in investing. And the biggest problem why individual investors have a hard time doing well in the stock market, because they let their emotions guide them. And if, on the other hand, let me close this or make it shorter. Okay. So if you just said, I'm going to stick to my schedule, which happens automatically for 401ks, right? If you just leave it alone, it takes a portion of your paycheck. And the great thing about this last 6-8 months that's happened is if you're investing every 2 weeks, you're buying in at cheaper and cheaper and cheaper price points. So it's counterintuitive because you want to be seeing your accounts go up. But if you've got a few years, it's great when you're investing and the market's going down because it allows you to buy at lower price points, which then allows you to profit that much more powerfully when the market flips around and starts going back up. Because every time, so if you had bought right here, right, in June 17th, 2022, that was the lowest point, you would already be profiting from that point because you bought in some on sale and now the price is higher. If you wanted to sell what you bought in June, and if you wanted to sell that today, you'd make a profit. And every time now we pass the time that you bought in is when you profit even more. So you really have to tune out the noise of what the heck is happening in the stock market, even though it doesn't feel good, and know that you're investing for later, not for now, and you're buying in at discounts and you keep on going. So even right now, and another thing is we've always passed where we've been. So it's almost like a given that we're gonna pass where this peak that we've had, even though it looks like super high. Yes, it could crash further, but that's fine too, because you'll be able to buy it cheaper. But if it goes up, you're right now already almost, I can't say you're at a guaranteed 13% gain, but it seems like that because it's always happened. We've always passed where we've been. So if we get to back where we were, you're going to be 13% more wealthier than you are right now if you invest. But that means we could go further down. And so that's the whole point of that thing. But take a quick look at time. Now, the other thing, this is what you can do to compare to your 401k as well as other stocks. Underneath this chart, there's this button that says more about this investment. So you scroll down and then you can click compare to, and you can enter different things. Let's do like Apple, AAPL. If somebody has a specific fund that they're invested in, I'll put it in right now and I'll show you what it looks like. Drop it in the chat if you do, and let me know because I can't see the chat right now for some reason. But let's just look at Apple. This is why I like to use stocks and funds, because you could see the fund has, even though it's done really well over 5 years, Apple's crushed it, right? It's crushed it. It's done way more. The S&P 500 is up 70%, Apple's up 300%. But when it crashes, it can crash much more significantly. So that's why I don't put 100% in there, because I personally do get freaked out when my money goes down, even though I try not to, even though I know better. It's still, I'm human, right? We're all going to have that emotional reaction. The important thing is to not act on it. And just over time, it's done really, really, really good. But I still like to have that core approach. And I personally don't use all the S&P 500, but of my 80%, and for somebody that's more of an aggressive investor, that 80%, then I split into 3 funds. I like the S&P 500. Let me show you why, actually. That's that quilt chart. Okay, this is the case for diversification. I am going to show you this. There's a certain one that I like because it's updated with last year's information. Which one is it? I need to bookmark this. It is this company, but I don't know. Okay, this doesn't have today's 2020, but it's in here somewhere in this site. Anyways, what you see in this chart is different. Each one of these colors represents a different type of investments. So large cap that we were just talking about is this dark blue. Now, what we see from this chart is there's no pattern. And the things to just know about this chart is from left to right is time, from top is best performer to bottom is worst performer. So the whole point of diversification is getting into a few of these different types of investments, because none of them are always on top, none of them are always on bottom. And if you only are in one type, you miss the years that others are in, that others are doing really well. So that's where this gray line comes in. It's a diversified portfolio, meaning it's got multiple of these different types of funds. And over time, you can see on this right-hand line, it says large cap has done the best, which is why I like to keep the majority of my 80% in large cap. But small cap has also done really well. I like to have a little emerging markets. I don't have a lot of money managers and a lot of target date funds have so much international. They have like the same amount of international as they have in large cap stocks. And that's where it really drags their performance right now. Well, for the last 5 years, a lot of those target dates have just done really, really poorly. And also they have a high fee. So instead of being in a target date fund, you could do it yourself. And it takes a little more work, but not that much more work. Because the target date fund is probably charging you like 0.6 to 0.8% versus an index fund, you can pay like 0.04% or something. So significantly less. If you have a small account, it doesn't really matter, you know, the difference between paying like $10 a year and $2 a year. It's like not that big. But if you've got a bigger account, it's really worth taking a look, because that could be thousands. Like I just looked at a girl's and hers was like a $50,000 amount that she would pay if she stayed in her target date fund. Yes, it takes a little more work, but in my opinion, it's worth it. But anyways, the diversified portfolio, the gray boxes you'll see is never all the way on top, but it's also never on bottom. So you have to ask yourself, if you hate that idea of your money bouncing all over the place, get into a more diversified portfolio and you'll stay more steady throughout your investing time. I don't mind being more aggressive, but that's where it's like varies so much. So let me go back to that. So when you're asking like how to invest, if you did a few index funds and a few stocks. So we own about 6 stocks, and 20% of our money is in 6 stocks, 80% is in index funds. And that's all considering our 401ks, our IRAs, and our regular accounts. I look at all of it and do the 80-20 mix. And that's how I decide how we're gonna invest. I hope that helps, and it wasn't too much, but I do have a course right now that it's an investing for beginners course. So if you're interested in that, I would definitely have you look. The doors close to that on Monday. And I take you through this whole process, start to finish. And I would love if you have any interest in that to take a look at it. My website, I'll drop the link for it, but let me just give that to you right now, just in case you do want to take a look.
Maggie, I dropped the link already and I can drop it again.
Cool. Okay.
I'll send it out with the replay as well.
Okay. Yeah. Okay. So now we talked about what to invest in and the current thing that's going on, right? We are down in the market, but if you've got more than a few years, then I would just keep on investing and tune it out. But if you're retiring in like 5 years, then it is time to sit down and actually say, okay, you need an income strategy. You probably don't want it all invested really aggressively because of the risks. So that's where working with somebody, and I do work one-on-one with clients to help with this type of stuff. But that's where it's really important to like figure out your income plan for retirement. Once you're within that like you're like 5 years out, maybe even 10 years, you can start thinking about it. But especially if you're 5 years out, you can really put together a solid income plan for your retirement so that you know how to invest for the next 5 years, basically, and well into retirement. Okay, let me see. I didn't have too much left on this, but so keep asking questions if you have those, because it looks like we'll have a little bit more time. So just kind of tying it back to the Napoleon Hill thing, think through investing. So with Napoleon Hill's idea, it's going and saying like, okay, well, when he says, what are you going to do in exchange for the money? And in case of investing, you're going to put money into the stock market. In the case of being a business owner, you're going to put out your products and services. And in the case of working for a company, you're going to show up for work and do a good job. So that's what you do in exchange for your money. But with investing, you put money in the stock market. And that's how it kind of all ties together. So now, how do you get started with investing? We just talked about that a little bit, but the other questions that come up is like, how much do you start with? What accounts do you use? Which investments and all of that stuff. So let me see. Oh, I do have a quick start guide I can drop for you too. I was looking at this. Okay. But let me see how much. Oh, it's just questions. Okay. I wanted to see what was ahead on my slides. What was I going to say? Oh, the like, how much should you start with? I would just really do like as much as you comfortably can. So it's going to be like looking at your budget, seeing how much you have to work with, and working your way backwards. If you're not used to saving a percentage of your income, you have to start with what you can do and get yourself to the point of being able to do a percentage. If you could do 10, 15, 20%, that is a great start. The more, the better. But don't let that limit you, and don't wait until you can do that. If you can only start with 5% of your income, that's fine. Or if it's like $20, like I said, start with what you can, so that you most importantly create the habit of investing and then grow that habit over time. So I'm at Money with Maggie everywhere: Instagram, YouTube, and my website is moneywithmaggie.com. Now I just want to open it up for questions for the rest of the time that we have together. So I'm going to stop sharing my screen.
Hi, Maggie. My name is Megan. Can you hear me?
Yeah.
I'm sorry, I'm driving, so
That's
but
okay.
I've been totally enjoying your presentation, and one of the things that gets there's a couple of things that I wanted to ask you. One is like, if you're not getting paid very much per year, anyways, like how do you start to save? I mean, my base pay at my main job is very, very minimal, like compared to what my degree is, which I have my PhD. And so it's like, one is like, how do I figure out like how, because I feel like I am living paycheck to paycheck. I don't know why I'm still living like this. I'm 40 something years old, and I don't want to live like this anymore. It's like I am very motivated to live very comfortable, and I have big dreams. I've read Napoleon Hill, and I want $180 million. That is been in my mind. That's what I think about whenever I think of a number. And the way I'm going right now, it's I try to like put stash here and there. I have a TIAA CREF kind of fund, and I've got another investment fund from when I was married. And so, but I guess it feels impossible to think about how I could squeeze out a little tiny bit of more money out of my account. What were some things that you did, like you got like literally, like you got really like specific, like I'm not gonna pay for this, or I'm not gonna buy that this month, or I'm like, did you, when you were getting into it, like how did you make those decisions? And that's my first question.
Okay, so there's two things that are going to work together for you to conquer this situation. one, there's the short-term thing, which is cutting expenses. And what you really have to do is sit down and look at where you've spent your money for the last 3 months. Okay. This is your homework assignment. You go, you print out your bank statements, or you go download them into an Excel sheet, a Google sheet, and you really look at every single way you've spent money and really and categorize it. Okay. So when I first did this, there wasn't like, I wasn't tech savvy. I used a highlighter and I categorized everything. And then you just ask yourself, like, where is it that like I'm spending money that is bringing me no value, that I'm just like, what the heck, why did I do that? Those are the first areas to pull money from, and immediately just stop that spending, because you're like, it's not bringing me more value. And I feel like it's a waste, and it's like, I could be investing that money. So that's kind of the short-term first place, is look through your spending, see where your money is slipping through the cracks, grab that money, stop the leak, and put it. And what like some like more gritty things I did was like, anytime I said no to something, I immediately moved that money from my checking to my savings account. Like if I didn't buy French fries at Wendy's, I put $1 in there. If I didn't go to dinner with friends, I took $20 and put it there. You know, like whatever you're saying no to, immediately put that money into a savings account. So you give yourself that gratification that you're not just depriving yourself, but you're doing something good for your future. I also greatly made sure my expenses stayed low. I got a roommate. At one point I shared a room with my 7-8-year-old daughter, and my best friend slept in the living room. So if you're really, really, really determined, you do crazy stuff like that. I'm not saying everyone has to do that, but that's what I did. I drove a 1999 car that I bought for $4,000. Like if you got a high priced car, you got to sell that car, do everything you can to get out of that car into a super cheap car. Even if you have to repair it from time to time, it's still way, way better. So that's the short-term stuff. That's not going to make you wealthy, but that's going to start the discipline of living on less. And at the same time, you work to increase your income. So you have to start looking at what jobs pay more than I'm currently making. You might have to leave your current employer to go to another firm, or apply at other firms and bring that information back to your current employer and say, look, I love working here, but this other company is offering me $30,000 more than you guys. Like, what the heck? I mean, don't say it that way, but like say it in a better way.
In my mind, I would say that.
So that's where you've got to be aggressive with going after a higher income and reducing your expenses, because going after higher income, that might be a few-year plan. It took me a few years to get to 6 figures, but I strategically went after a 6-figure job and got certifications, designations, did all the stuff. But in the meantime, that's when I shared a bedroom with my daughter, my friend lived in the living room. Like, it was crazy. It was worth it. Or if you already have a house, like rent out a room in your house, get gritty and like really focus on that. That's if you want to get really scrappy and gritty and like go after it. Not everyone has to do that. But I think that is my guidance to you starting out.
That's great guidance. There's one more question I have. I have a TIAA CREF account, which is because I'm a faculty. And so I've had this for a long time because I've worked in higher education since I graduated from college. And that is a regular kind of a thing, but I just see that as like a retirement thing. I mean, I could go into it but I was thinking like, how do I choose like what to invest in? I mean, I saw your chart where you had all those different kinds of like diversifying as a really important thing, but I don't even like, I mean, do I go to like E-Trade online and start like trying to fiddle with that? Or like if I have an extra $1,000, what do I do with it? And so what are your guidance on that? Yeah.
So TIAA Craft, one thing I'll tell you is you're probably paying more fees than you need to be paying. So you might want to, if this is an old place where you had a 401k, you might want to consider moving it to an IRA. But let me share my screen with you and show you something, because also I got a question that says, how can I find the fees in my ETFs? Lynn's asking that. So this is, let me get a screen shared so I can show you this. Okay, so we're gonna go back, and I'm glad that the question came up because, okay, do you see this Google sheet again that I'm on with the S&P 500? What I'm gonna do is, let me see. Fidelity Freedom Fund. Okay, this is the one that I looked at that I told you I'm saving this girl like $50,000 because I'm like, this fund is so expensive. So the question, or one of the questions was, how do I see the fee? So I'm just pulling to research what you're currently in. You need to find this 3 to 5 letter symbol, or you could just take the whole name, enter it in here. So we're just going to look at this 5-letter symbol. So when you look at your 401k, you're going to have all these like 5 different letter symbols, put them in here. And this is, then you expand the time. And if it doesn't show you the expense ratio, so this is how you see the expense ratio. Right here, you can see expense ratio 0.75%. If you don't see it, because ETFs, you won't see it here, but you type in the 3-letter thing for the ETF and then type in the word expense ratio, and that will tell you what you're paying. So I'm just grabbing my calculator real quick. What you do is you take that expense ratio, you take the dollar amount that you're invested. I'm just going to use $1,000 for a simple thing. $1,000 times 0.75%, make sure you hit that, equals $7.50. So for every $1,000 you have invested, you're paying $7.50 per year on this fund. That's why I say when you have a little bit invested, the fee like $7 a year, that's fine. But if you have $100,000 in this fund times 0.75%, you're paying $750 per year. You compound that out 20, 30 years, it's getting into a lot of money. And then, oh, did I lose you guys? Oh no. Okay, I think it just got really quiet all of a sudden. Okay, I think you're still there. Good. So you compound out that fee, and with TIA Craft, you want to, with any firm, enter the individual investments you're in, and then you can also compare it. So you click more about, and that's why you click compare, and it's not going to be like, if you put in the S&P 500, the S&P 500 has returned 70%. Well, this has not done anything over 5 years. It is actually 0.023% over a 5-year period of time. This is what this has returned, which is really, really frustrating and sad. And I spent like hours researching this because I was like, how is this possible? But I did get to the answer of it really. And it's very diversified and a lot of international funds. So if you look at the S&P 500, and it doesn't have to just be the S&P 500, but you could put in your own international and your own small cap and whatever. But you don't want to see where you've had no performance over 5 years. And this is their aggressive 50-50 or 50-55 fund. So that's the importance of optimizing your portfolio. And to go back to your question with the TIA Craft, you look at what you're in, and then you can actually move that to an IRA and restructure your portfolio. So let me take a look. I'm happy to stay on a little bit longer and answer more questions for those of you that have them. I see one that was sent directly to me from Bapti. I'm sorry, I don't know how to pronounce your name, but is the S&P stock a set of the same stocks, or do you buy it as the S&P? Do you have a broker to buy it? You can buy it on your own. I really love the firm Fidelity because you can buy fractional shares. So if you don't have a big budget to work with, you can buy any stock or fund at any dollar amount if you're with a firm that offers fractional shares like Fidelity, Schwab does. I also like this company called SoFi. And what you would do is you would type in S&P 500 index fund. There's tons of options as long as they say they're an index fund or an ETF, like I'm in SPY, which is an ETF. And that's what gets you into the type of investment, and you buy it. You don't need a broker. You could do it on your own. And this is what I teach throughout my course. So I really encourage you to take a look at that, because it's really a great way to answer all of the questions. But you can do it on your own, which is what is so freaking great, because you could just save so much over time. And it's not all about fees, but you have to balance that fee versus performance. And Lynn says, so what are good expense ratios to shoot for? With index funds, you can get in at 0.0 something. If it's 0.0 something, it's great, because like looking at that past example where if you had $100,000, you're paying $750. If you instead, this is where I should be better at this type of math, because it's simple, but I always get confused. But if you instead were paying like 0.04 times 0.04%, oops, 100,000 times 0.04%, you pay $40. $40 instead of $750. And that's like $4 versus $7 or $4. Like you can see how the numbers are significantly different. 40 versus 750, and compound that over time, it makes a big difference. I definitely would say that under 0.6, under 1% for sure is okay if you're getting the performance. But if you're not getting great performance and you're paying more, index funds just keep it so cheap. So that's why you can get usually the same performance or better than a mutual fund. And that's why it's important to take a look. That way you at least have the knowledge of what you're paying. Okay, Christine, thank you so much. Thank you. Thank you all for being here. If you have any other questions after this, feel free to send me a message. Maggie@moneywithmaggie.com is my email address. You can find me on Instagram and DM me and all of that stuff. Take a look at my course. It's only available. This is my last offering because I am very pregnant. So I'll give you a little bump shot. Here we go. But yeah, I would love to see you in there. Doors close on Monday for that. It's $497, very affordable if you think about all the money you're going to make and save over time. So that's my little plug there.
Maggie, this is Megan again. I'm driving. So could you, did you put your contact and all that information you just told us in an email?
I think Gina did.
Okay. All right. Good. Very good.
Hi,
Great.
Megan. Yes, I will send a link to a recording out to everyone, and I will definitely send everyone an email with Maggie's contact information. And also, I believe Maggie is like on the Institute's website because she's a partner. So you can also access her info there, and I'll send a link to everybody so you can access that. And I know that Maggie's going to be out for a bit because, as she mentioned, she's very, very pregnant. So thank you for doing this with us. When you have a little one on the way anytime now, but my hope is that Maggie's going to want to come back in spring and do some more work with us. And also, I believe Maggie does also one-on-one coaching and support around financing. I actually know that I am scheduling with Maggie for some one-on-one support. So that is something you might want to reach out to her about as well. So
yes. And I still have 6 weeks that I'm working, or 5.5 weeks. As long as I feel good, and for the course, I'm pouring the next 5 weeks into my course students and everything. So that's, even though the baby's coming, I'm still in the game for a little bit longer.
Right. Yes. Thank you so much, Maggie.
Oh, you're welcome. And one more thing, I am going live today at 3 on Instagram. If you wanted to pop over and ask any other questions, like I'll be there giving 3 tips to establishing.
So not used to the time change.
Financial foundation on Instagram.
I should have been here at 10 instead of at your mom's. Pardon?
I think she's not muted.
Yes, yeah, yes. Maggie, this was really, really wonderful. And I know people stayed on a little bit late. Thank you for staying on a little bit later. This was fantastic. We really appreciate the guidance and info. And I will get everybody your information. I know we had quite a few registrants. So I know some people just weren't
Yay.
able to make it and really want the recording and your information. So I'll make sure I get that out to them. And I want to
Awesome.
tell everyone, check out Maggie's YouTube channel. Check out her Instagram account. Great information there for you as well. And I wanted to say that as a partner, Maggie has been sharing information with us. So check out the Institute's resource library for additional information from Maggie and ways to connect with her. Okay.
Thank you so much, everyone, for being here, taking this time to plan a better future for yourself. Thank you, Gina, for bringing me on. And I'll see you guys all next time.
Thank you, Maggie. Thank you, Gina.
Thank you.